Welcome to Yahoo Finance's special coverage of the June CPI report. I'm Julie Hyman. The key inflation number just crossing the wire and coming in somewhat in line with estimates. 0.3%, a month-over-month increase in the consumer price index. If you take out food and energy, the increase was actually smaller than estimated, 0.2% versus the 0.3 that was estimated. And then as we take a look at the year-over-year numbers, consumer inflation rising 2.7% year-over-year. If you take out food and energy, you get a 2.9% increase. Now, even though that core inflation month-over-month number was a little bit milder, a little bit more benign than estimated, it still represents an acceleration from what we saw the prior month here in the month of May, where we saw headline and core inflation ticking up just 0.1%. So inflation heating up just a little bit here, but still coming in core a little bit milder than estimated. It is interesting, the year-over-year numbers not showing any kind of being more mild than had been estimated here. So this is the fifth straight month that we have seen that core print has come in a little bit lower than had been estimated. What's interesting here, of course, are the implications. The implications of what this is showing in terms of tariffs, because there's been a lot of attention, a lot of questions about why we are not seeing more of the increase in tariffs feed through to some of these numbers. There are implications, of course, as a result for the Federal Reserve as well, and whether they are going to cut rates at a time where they are under enormous pressure from the White House and President Donald Trump, who has been very vocal about his desire to have them cut rates. So a lot of different implications, a lot of reasons to be paying attention to this number here today. If you look at it, take a quick check on what is happening in the futures as a result of all of this, we are not seeing much movement, a little bit of a tick down in futures from where they were before this report came out. We're going to be keeping an eye on other assets as well, but typically it takes a little bit of time for people to go through the data and to make sense of it. We're going to do more of that right now as well. Joining us now to break down this inflation print, Gregory Dacco, EY Chief Economist, and Claudia Sahm, New Century Advisors Chief Economist. Thank you both so much for being here. So, Greg, a moment ago, I was talking about the sort of feed through from tariffs here. Once again, we're looking at a core number of 0.2% that is less than the average economist estimate. What's your first reaction here to this number?
Well, I think you're absolutely right. We were anticipating that about a third of the monthly increase in CPI would be driven by the tariff increases. It seems to be from this initial read that it's a little bit less than a third. But still, you're starting to see some of the pressures emerge in some of the categories that were first exposed to the tariff. This month, you saw a rise in apparel prices. You're also seeing higher furniture and furnishings prices. You're seeing higher recreational goods prices. So there is a little bit of an initial influence from the tariff, but we have to keep in mind that businesses have been using a wide array of strategies, from inventory management to sourcing from different places to spreading the cost increases across different goods, as well as using their margins to buffer some of the shock as an initial mechanism to avoid passing on the cost to consumers that are, as we remember, very sensitive to these higher prices. So this is just the initial onset of these tariff increases, and we're going to see more over the course of the summer. I expect a fairly muggy summer when it comes to inflation.
Claudia, what about you? Are you kind of seeing the landscape and the feed through from tariffs in a similar way?
Right, I agree. This is an adjustment process to a massive cost shock that businesses are facing. And so, we learn from the data how this is feeding through. And I think it's going to take some more time for us to, get a sense of the full effect of these tariffs. And, remember that we aren't done in terms necessarily with the price increases through tariffs, because the tariffs aren't set fully. So I think this is something to watch in the data, but I agree with Greg. You can see in this month ever more, an impact from this on prices. The, core goods did move up their month over month inflation in June.
And Greg, I guess the thing that I continue to struggle with, and I know this is something you guys are thinking about, the Fed is certainly thinking about it, is why and how, when we do start to see the tariff effect, why it would last longer. In other words, the Fed's trying to figure out when is the increase in tariffs going to make its way through to these prices, A, and B, will it be a lasting effect? Will it be, going to use the word transitory, or will it be lasting? Why wouldn't it just be that one-time adjustment? What would cause it to last longer?
So I think two things are important here. One is the effective tax rate, when the tariff rate, the effective tariff rate. When you look at collected custom duties, you see that in the month of June, the effective tariff rate was only 10%, when the average tariff rate was around 15%. So the tariff bite has yet to fully materialize. The second thing is whether this is more of a one-time shock or a persistent inflation shock. I would tend to believe, based on a number of surveys and a number of conversations we're having with business leaders across a wide array of sectors, that this is going to be more of a one-time shock. That does not mean it happens overnight. It means it happens over the course of a year, but it's still rather transitory. And the reason why we believe that's the case is because a lot of businesses are talking about rapidly passing on the higher tariff shock from these higher duties. So we're anticipating a rather swift pass-through. But if we are in an environment where there are staggered tariffs over the next year, then there is a risk of more inflation persistence. And I think that's the key risk for the U.S. economy right now.
And of course, we don't even know what the tariffs are going to be next month, let alone if they're going to be staggered. So Claudia, let's bring it to the Fed. I mean, they've got a tough decision once again ahead of them. What are the risks of them continuing to wait?
Well, the federal funds rate is what the Fed characterizes as moderately restrictive, right? So it is putting downward pressure on the economy, on demand. I mean, that's the tool the Fed has to bring inflation down. And I think to add to what Greg said, it's really important to set this in context. The inflation in the United States has been above the Fed's target since 2021. It is still elevated, and particularly services inflation remains quite elevated. The Fed is committed to getting inflation back to its 2% target. And I think a risk with tariffs, which might not normally apply, but a risk here is that because we've been at inflation at an elevated pace for so much time, that people are just going to build that into their thinking. Right? Are they going to think, hey, we're going to get 2% inflation going forward? Or maybe they'll get stuck at this around the 3% level. And that's a big risk to the Fed. And that's the only reason that it is keeping interest rates in a restrictive place, because it wants to get inflation back down to target. And I think, we have seen some progress this year in terms of inflation. I think it's really important to look at these core services. We have made some progress, but they need more reassurance that we're on the path to 2% and that these tariffs are not going to throw us off and really get stuck above target.
And Claudia, when we talk about tariffs, we're mostly talking about goods pricing. But of course, services pricing is the thing that, until we got into this whole tariffs discussion, was the thing that was stubbornly not coming down. Are we seeing any progress on that front?
Right. Well, in recent months, we did see some notable progress. And I think you saw travel inflation, recreation being really soft, things where you'd think, oh, maybe this is there's kind of a softening of demand, which again would be an environment where maybe tariffs wouldn't have that spark to inflation. And we have seen a real kick to some of the rent, owner's equivalent rent slowing down, which had been waited for a long time. I think we saw a little bit of give back in today's data. Things are noisy. We're not going to, be on a glide path. But the Fed, tariffs are a risk. Normally you would, quote unquote, look through them. The Fed would ignore them because they're a one-time adjustment. But it's really important, if the Fed looks through the rest of inflation, which is largely these core services, have to give them encouragement that we have the momentum to 2%. I think they're building that case, but I don't think it's a slam dunk yet, and particularly because the economy, the labor market seems to be holding up relatively well. They've got a little more time to do their fact finding and bring the data in.
And Greg, I want to ask you about the Federal Reserve as well and its reaction to all of this, especially in an environment where, I don't know if we've had a post on Truth Social yet, but I'm sure it's only a matter of time before the president reiterates his call for rates to be cut. And this, of course, as we know, that the White House is looking for the next Fed chief. So amidst all that pressure, what do you think the Fed does?
Well, I think generally speaking, I agree with what Claudia was mentioning in terms of the disinflation on the services front. I'm a little bit more optimistic because I've seen some very encouraging news in terms of what we're seeing on the shelter cost disinflation front, also the auto insurance disinflation front. And if you look at some of the details in today's data, you'll see that hotel prices are falling. You'll see that airfares are also falling. So you're seeing signs of consumers being more cautious with their outlays, which is generally disinflationary. So we have these two currents. On the one side, disinflation that continues and has been occurring over the past 18 months. And on the other, the onset of the inflationary push from tariffs. As we know, the Fed is quite divided. There are 7 policymakers that would favor no rate cuts over the course of 2025. There are 8 that would favor 2 rate cuts and a couple that would favor 1 rate cut. So there is a big split within FOMC policymakers. I would tend to believe that there is room to be easing, but as policymakers, those that favor rate cuts will want to see more evidence of an economic slowdown in the data before they proceed with such easing. That's not yet evident, and I think the Fed will wait until the later part of the fall before it proceeds with the onset of any rate cuts.
Greg and Claudia, great to see you. Thank you so much.
Thank you.
Great, thank you.
Let's send it on over to Jared Blickery, who's back with a look at the movers on the back of this June CPI report. Hey, Jared.
Hey, Julie. Well, let's dial up the Wi-Fi Interactive behind me. Just before the report, we saw the Dow and the Russell 2000. I'm going to circle them right here. They were in the red. They're still in the red, but a little bit less red. And then we got a little bit more green out of the S&P 500 and the NASDAQ. Let's see how these stock future indices are doing right now. And here we had this little reaction function to the upside in the Dow futures, and we've come down. This is a very small move, and I'll show you the Russell 2000 as well. You can see we got to the highs overnight, but then came back down to break even. And let's do the NASDAQ as well. You can see that's still holding on to gains of about 0.5%. And I'm going to show you Nvidia at the end here. That's not a CPI reaction, but it's worth looking at. But we'll do that at the end. I want to take a look at bond futures right now, and just remember that these move opposite the direction of yields. So here's the 2-year Treasury note futures. Those climbed into positive territory, meaning that yields came down right after the report, but they're just kind of zigzagging, and they're really not that much more elevated than they were prior to the start of the report. And here's the 10-year, and you can see that actually climbed to the highs of the night. That means that the 10-year yield came down to the lows, but that has since retraced that action. And a very similar story for the 30-year, not shown here. Let's take a look at the futures markets, and we are seeing gold move the opposite way of stock futures, and we can see that's down right now. And if we think about how markets typically react to these big reports, it's all about expectations. So 0.3% was the number to beat or to miss in terms of the headline number and the core number. And basically we came in line there in headline and a little bit under in core. And so that just gave the market some breathing room. I'd be surprised if we saw a huge move down based on just this news alone. Now we could get some tariff news, but even tariffs didn't spook the market yesterday, did they? We still managed to eke out some gains into the close. I want to take a look at Bitcoin real quickly. Really not doing much here. I'm circling the price reaction, which is almost nothing off of the report. Remember, yesterday it hit 123,000, and it's very volatile, so it's down about, 6,000 or so, but that's a drop in the bucket considering how much it moves on a daily basis. And then here's the sector action. This is what happened yesterday. Pay attention to those background colors. Those are not going to change. When I throw on the overnight quotes here, those little rectangles are what's happening in the morning, and we can see XLK here, which was down just slightly yesterday, is up 1.1% in the early goings here. Communication services is second. Real estate is also in the green. So is industrials and utilities. To the downside, financials are leading the way down. That's off of JP Morgan and some other reports that we'll go to in a second. But I did want to show you the NASDAQ. Now, Nvidia is up 4.5% to about 171. 164 is the closing price yesterday. It's up another $7 in the extended market, and that is good enough for a record high. So we'll have to see if that sticks into the open today. And finally, I'm going to close with a look at some of the banks here. JP Morgan down about 27 basis points, Wells Fargo down 3.3%, and Citigroup down Citigroup up 1%. So kind of a mixed bag with respect to some of those big bank reports. And on that note, I will send it back to you, Julie.
Jared, thank you so much. Appreciate it. Coming up, we're going to have more on the June CPI report next on Yahoo Finance. Let's do a quick check of the Treasury market here. We are watching what's going on after CPI data showed inflation remained subdued in June, seeing a little bit of a move down in yields. Joining me now, Colin Martin, Schwab Center for Financial Research and Fixed Income Strategist. Colin, thank you so much for being here. So we saw that core inflation number month over month rising 0.2%, a little bit better than estimated. we were just talking with a couple of economists about when we might see the tariff pass-through start to show up. And they said you are seeing it in different ways, and you will see it more. So how much do we even, sort of key in on this number?
Yeah, I think every number does matter. But I think they're right in that we're seeing a few things at work here. There are certain sectors where the tariff effect is clear. Furniture is one thing that people point to a lot. We saw that increase, some apparel. So imports specifically from China, we're seeing that. But then we have to look at the big picture. It's not just goods inflation that we want to focus on, it's services inflation, and we're a services economy. But on the goods aspect of the equation, I think it could take time. On the one hand, you had a lot of companies importing kind of in advance of the risk of these tariffs. And then I think also the idea that maybe companies were a little bit hesitant to fully pass it along, knowing that there's a lot of uncertainty, a lot of volatility, and maybe the hope that there could be deals down the road instead of causing this shock to their clients. At the end of the day, someone's paying these tariffs. That's what we know. I mean, we're hearing about the money that's getting paid, every time there's an imported good. It could be the exporting company kind of lowering their price. It could be the business who's importing it. It could be passed on. Could be all three. If it is companies in the U.S., the importer absorbing that worries us a little bit because we're already starting to see corporate fundamentals deteriorate a little bit. If we look at the first quarter, on the bond side of the equation, we don't just look at S&P earnings, we look at data from the BEA and corporate profits. They declined in the first quarter by the largest amount since, I think, December, the fourth quarter of 2020. So I think businesses were already kind of feeling the effects of maybe slower demand, maybe the weight of high interest rates. And I don't know how long they'll be willing to pass that along. So maybe over time we do see the uptick. But there's also services disinflation or outright deflation. We saw airline fares fall, we're seeing hotel prices decline. That's concerning. So even though inflation is still above target, if under the surface we're seeing signs of slower demand, what the Fed actually can help, then maybe that pulls forward those expectations, or maybe the markets begin to reprice when and how many rate cuts we see.
Interesting. Okay. And so as we look at rates and where they have been, the 10-year Treasury, which has been mostly trending down, does that make sense to you? What's the kind of level that you think is appropriate given all of the things you're talking about?
We think 10-year Treasuries might remain range-bound for a little while, and that's really what we're telling our clients, because not all Treasuries are going to react the same way to potential Fed rate cuts. So we're highlighting the risk that short-term rates will probably continue to decline, but we're not so sure that long-term yields like the 10-year Treasury will follow suit. We think it might stay in that 4.25 to 4.5 range for a while, mainly because of all the trade uncertainty out there, but also fiscal concerns. Now, we've never really been big believers in bond vigilantes or the idea that we're going to see this surge in yields because of fiscal deficits. Just the data hasn't supported that case. But there's really no progress being made. And the outlook is for more deficits and more debt being issued. That just means that maybe Treasury yields need to kind of stay, long-term yields need to stay at this level to attract that potential marginal buyer. So we're not expecting a big surge. I know that's a fear for a lot of investors out there, but we don't think they're necessarily going to fall sharply once those rate cuts arrive.
Which is interesting because President Trump has been explicit that one of the reasons he wants rates to come down is because all the spending he's doing is making it, and already the debt that the U.S. is carrying is expensive. Servicing all that debt is very expensive, and he wants it to get a little bit less expensive, although we're still talking about, many billions of dollars here. So is the risk that even if the Fed brings rates down, that cost to service that debt is not going to come down significantly?
It should come down marginally because, we do have a lot of short-term debt, so that would help.
Got it.
But what does it do to investor confidence? What does it do to the dollar? And what does it do to long-term yields as a result of inflation expectations? We're still in an environment where the labor market's relatively stable and inflation's above target. And we were just talking about this before, that the Fed hasn't even hit their goal yet. They've been above target for 4+ years now. And to cut rates now risks stimulating the consumer a little bit more, stimulating businesses a little bit more, and then that might fuel more and more inflation. So that's a concern for us. So if we were to see a very, very sharp decline in interest rates because of a potential new Fed, we worry what that does to the long end of the yield curve.
Interesting. Okay. So so if you do get a new Fed in there that is clearly dovish and clearly servicing the president's wants and desires, what does the market do? Could you have sort of these counterintuitive moves as a result?
I think it depends on who comes in. There's been a lot of names floated out there. I think if it's just a change from Powell, because that's clearly what the administration wants, but it's someone that's kind of in the established community and is suggesting lower rates, but maybe not to the 1 or 2% level that we've heard, tweeted out and things like that. I think that would be one thing. If we got someone in who was, pounding the table for significantly lower rates, I think that would cause a lot of investor uncertainty out there, a lot of volatility for the Treasury markets. But also, the Fed chair is just the chair. There's a whole committee that makes the decisions. But again, that confuses the issue also. I mean, we've seen over the past handful of years, 10 plus years, how much communication we get from the Fed. And I think it really highlights that it is a committee and not just one person. So even though Fed Chair Powell does the press conference, after that meeting, we get interviews and speeches from everybody about, hey, this is my view. So even if we got a new Fed chair in there, the views of the committee members might not change. And they'll likely continue to go out in their circuits and do their interviews and do speeches and say what they think is best. What I think that results is just more uncertainty and probably more volatility in the Treasury market.
And probably some more tweets as well, or truths, as we like to call them. Colin, thank you so much. Appreciate your perspective. Well, core inflation rose 2.9% in the month of June. Joining us now with a breakdown of the categories that gained and lost the most in the month is Yahoo Finance senior reporter Ali Canal. Hi, Ali.
And yeah, for the month of May, we did see apparel prices and car prices fall, and that kept inflation relatively tame. We did see some signs of tariff pass through for the month of June, although not at an alarming rate. We still have inflation that's relatively subdued at that neutral level. But let's talk about some of the price increases that we did see. I mentioned apparel prices. That index increased 0.4% last month. Footwear also saw a 0.7% increase after multiple months of declines. Furniture and bedding, that rose 0.4% after a 0.8% decrease in May. So a potential sign there that tariffs are beginning to work their way through the system. Beef prices stood out to me, pretty significant jump there of a 2% increase. However, egg prices, that decreased 7.4% month over month. This has been a very volatile category, one that we've been watching closely as a gauge when it comes to just how much pressure the consumer is facing at the grocery store. And to that point, the index for food increased 0.3%. Food at home rose by that same level, while the index for food away from home rose 0.4%. Now, that was an acceleration from May. So food prices continue to remain sticky. We're just unable to budge from some of these higher levels. But there were a few positive signs. New vehicles, that dropped by 0.3%. Used cars and trucks dropped by 0.7%. These were categories that we've been expecting to see price increases due to these tariffs, but we just haven't seen that materialize. Shelter also moderated month over month, increasing 0.2% compared to May's 0.3% rise. Shelter has been a very sticky category, a big elephant in the room when it comes to the Fed, so positive to see that moderating a bit. And then the energy index, that did rise 0.9% in June as the gas index increased 1% over the month. That contributed to some of the firmness that we saw in that headline inflation, likely due to the spike in oil prices that we saw a few weeks ago amid those Middle East tensions. Heading into this report, we had seen gas prices steadily falling, and they have since returned to those lower price levels. I'm looking at crude oil right now, hovering below $70 a barrel here. So largely neutral inflation report coming in mostly in line with expectations, and we're not seeing a significant impact of those tariff increases just yet.
Ali, thanks so much for those details. Appreciate it. We'll have much more ahead on CPI, on bank earnings, on Nvidia next. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures falling from session highs following the June CPI report, which showed inflation came mostly in line with economists' estimates. Core CPI rising 0.2% month over month, just under the 0.3% that was expected. The year-on-year number coming right in line with expectations. Plus, shares of Nvidia and AMD on the rise after announcing they can resume AI chip sales to China. The news marking a dramatic reversal from the Trump administration's earlier stance to try to limit China's AI ambitions. Nvidia CEO Jensen Huang, who is currently in China, met with President Trump before his trip and had previously called U.S. chip curbs a failure. And big bank earnings kicking off on Wall Street. JP Morgan reporting better than expected quarterly profit, as did Wells Fargo. The CEO of Wells said with the Federal Reserve lifting of its asset cap, the bank can now grow in ways it could not while that was in place. Meanwhile, JP Morgan CEO Jamie Dimon saying the U.S. economy remains resilient, but warns that risks still persist amid the trade war. Let's get a check in on stock futures right now. We've seen the Dow dip into the red here, indicating a lower open of just about 0.1%. The S&P and the Nasdaq coming down off their early highs of the futures session, but nonetheless still indicating a higher open, particularly the Nasdaq, because it is indeed getting a boost from Nvidia and some of the other chip makers. So a lot of things feeding into what's going on in stock trading today. Let's break it down for you and turn to the top stories of the day. CPI data giving us a fresh read on inflation, Nvidia getting the okay to sell its H20 chips to China, and big banks officially kicking off second quarter earnings season. Joining us now, senior reporter Ali Canal, senior reporter Brooke DePalma, live at the NASDAQ, and markets reporter Josh Schaefer. Ali, let's start with you and the details of that CPI report.
Yeah, so like you were saying earlier, Julie, inflation coming in mostly in line with expectations. We did see a firmer headline number, likely due to higher gas prices that came from that Middle East conflict. But by and large, we're not seeing tariffs aggressively impact these numbers here. But there were signs that these levies might start to be making their way through the system. So we did see apparel prices rise 0.4% last month. Footwear saw a 0.7% increase after several months of decline. Furniture and bedding prices also rose 0.4%, and that reversed a pretty significant drop that we saw in May. So all indications that tariff-related cost pressures are beginning to reach consumers here. Now, economists have said that increases in these categories show that we could see a filter through into core goods prices. They're saying that tariffs usually take some time to show up in inflation data, and because many imports were front-loaded, only a limited number of goods may have been affected so far. So while any inflation bump from tariffs is likely to be temporary, the recent wave of new tariff announcements from the president that we saw over the weekend suggests that the Fed should hold off on any policy changes. And to that point, I'm taking a look at CME, the FedWatch tool, and what markets are currently pricing. Pretty much a 100% chance that the Fed hold rates steady in 2 weeks at that policy meeting for the month of July. And then even for the September odds, we are now just below 60%. We have been above that level pretty consistently, but now investors are starting to recalibrate their thinking when it comes to the Fed's next move, if and when we will see an interest rate cut that potentially could come later this year, not in September.
And Brooke, you've been looking at some of the commentary around, expectations for CPI, the reaction now that we're seeing in the markets. What stands out?
Yeah, stocks are largely muted this morning as investors digest not only the CPI report, but also big bank earnings from firms like JP Morgan and Wells Fargo, and also investors keeping a close eye and a close watch on Nvidia after the Trump administration gave the okay to Nvidia to sell their H20 chips to China. And so taking a closer look, if you look, stocks are largely mixed this morning. The S&P 500 moving about 0.4%, the Dow moving lower after those big bank earnings, and the NASDAQ moving higher. One thing I'll be watching out for is if Nvidia continues to push the NASDAQ higher at the open. We're looking for a key number. We want Nvidia to open above $164.92. That will indicate a record high. But what we've been hearing from investors is that even though CPI came in largely as expected, what we've seen over the past few months, one economist saying that U.S. consumers seem able to really adopt these higher prices. And so it'll be interesting to hear in these earnings, like we heard from Delta, like we heard from Levi's, these higher prices really get passed on to consumers, and consumers continuing to remain resilient, and largely investors just simply passing this by. This report, stocks once again muted this morning.
Yeah, Brooke, I'm going to give a little more detail on Nvidia here. The statement from the company saying that Nvidia is refiling these applications to sell these H20 chips. Just a little precision the licenses haven't been granted yet. It's just that Nvidia says the U.S. government has assured Nvidia the licenses will be granted, and Nvidia hopes to start delivery soon. Stacey Raskin, analyst over at Bernstein this morning, out and saying, they'll probably get granted, as Nvidia expects they will, but we'll see once they actually start to happen here. The other thing to note is that the H20 recall is a less advanced chip that Nvidia already made in order to get around the existing export curbs against China. And then, of course, the U.S. came and said, no, you can't sell that one either. Then Nvidia developed another chip, the RTX Pro GPU, that in the statement, Nvidia says that's also ready to go in China as well. So now, even though China will still not have the same access to the chips that U.S. customers or customers in other places around the world can have, they'll have access to some of these other alternatives from Nvidia. The analyst notes I'm seeing this morning saying we're talking about $8 billion in revenue that was at stake this quarter as a result of these restrictions. So we'll see how quickly that now gets unlocked. But of course, there are a lot of questions still about the implications of this decision or this expected decision. Does this mean the U.S. and China are talking more? Is this an olive branch? So we'll have to find out from D.C. if more of these things are being talked about. Josh, in terms of the sort of broader market implications of Nvidia, and by the way, AMD, there are reports that it too will be able to sell some of its chips now into China. But there seems to be definitely a ripple effect here.
Yeah, Julie, you called it a potential olive branch, right? And I feel like that's maybe the market read this morning. When you look just broadly at the NASDAQ, you're seeing a almost 0.7% move up in futures tied to the NASDAQ 100. Yes, it's Nvidia up about 5%. It's AMD up about 5%. But Julie, you and I have been talking yesterday a little bit about sort of what is the market concern with this trade war. The past week has told us maybe it's not necessarily tariffs on the EU or tariffs on Canada or tariffs on Mexico, right? The market's sort of shaken off that news. We were discussing a note from Morgan Stanley Chief Investment Officer Mike Wilson sort of highlighting that China remains the key here. Well, China remains the key because tariffs from exports from China into the U.S. would impact a lot of tech companies, right? So to see perhaps something getting a little bit better in terms of U.S.-China relations, or at least U.S. companies' abilities to operate in China, it's a positive for the market, because when you think about tech being over 30% of the S&P 500, it matters a lot, right? This bull market has been a tech bull market. So for Nvidia to be surging to a record high, for tech to continue to catch that bid, when you have a lot of the market, we have very narrow breadth right now. There's not a lot of the market going up. Bank stocks are not up on earnings. Tech has been carrying the market a little bit. So to have that support gets you kind of consistently near these record highs, and again, gives a little bit of support to the broader market indexes as a whole.
All right, let's also talk about the other group that maybe is giving support, or depends, I guess, on where you look here this morning. The banks is what I'm referring to. JP Morgan, I'm noticing, is trading higher in pre-market trading, but what's the sort of takeaways from some of the bank earnings?
Yes, it was a bit divergent. So you had JP Morgan coming in with net interest income for the full year that was better than expected at about $95 billion, a little over $95 billion. It's about $1 billion higher than the street had expected. You can see shares up marginally there. They have been down marginally a little bit earlier. You flip over to Wells Fargo, which is at the bottom of our list there. Wells Fargo's net interest income for the current quarter came in a little bit shy. And then you look at Citigroup. Citigroup was really a trading story, trading activity in the second quarter. Of course, we talked a lot about volatile markets. Well, banks benefit from that, right? So that was really driving Citi. Another thing I wanted to highlight, Julie, just thinking about the overall market story, JP Morgan, very interesting to see deal making tick up a lot more than expected in the second quarter. That's driven by things like M&A, right? Maybe the IPO market. So investment banking came in almost $500 million higher than the street had expected. So a resurgence in sort of the Wall Street banking, investment banking thesis coming through in those earnings.
Guys, thanks so much. Allie, Brooke, Josh, appreciate it. Let's drill a little deeper now on those bank earnings. Executive editor Brian Sozzi's been listening into those earnings calls. He's joining now from the Yahoo Finance newsroom. So what are some of your takeaways, Soz?
Yeah, Julie, I got 3 different headphones plugged in through my different ears, so I can listen to Wells Fargo, all these companies, BlackRock too. But look, the JP Morgan conference call is the one I'm listening to right on Yahoo Finance. Great new function on our site. I encourage everyone to check it out. Really enjoy listening to it on there. Nothing real in terms of fireworks from this JP Morgan earnings call. Seeing the stock reverse some of those early losses after the print or the earnings beat this morning, now in the green here in the pre-market. Where the real fireworks, Julie, came in the reporter call, which JP Morgan always has about a half an hour before the analyst call. Jamie Dimon saying this is starting to make news already. He views the Fed independence as, quote, absolutely critical, and then also, quote, it's important for the Fed to be independent. So Dimon voicing support for an independent Federal Reserve, and of course that's in contrast to everything we've heard of the Trump administration in the past month. That is one that continues to attack Fed Chairman Jerome Powell, wants him to lower interest rates. Jamie Dimon saying it's important for the institution to be independent. That's my real takeaway so far here, Julie, on JP Morgan.
Yeah, really interesting. And as we know, he is always outspoken. Anything else from the other banks that you want to highlight, Saz?
Yeah, just how bad a quarter Wells Fargo was. 3 months ago, we were sitting here, not us, because I didn't buy into any Wells Fargo turnaround, but they were promoting the bank is starting to turn around. We're going to start returning capital to shareholders. This quarter really reversed all of that. You compare it to how Wells Fargo did in markets, investment banking, trading, you name it, whatever it is, they badly underperformed JP Morgan. And I suspect when Bank of America reports, they will show better results than in Wells Fargo. And I know they're not direct comparisons, Wells Fargo and BlackRock, but BlackRock is calling out this morning record assets under management of $12.53 trillion, a positive metric for them, completely opposite to what we've heard from Wells Fargo today. In addition, of course, cutting their outlook for the full year in terms of net profits.
Yeah, definitely. And Citi, by the way, just a quick mention of Citi, those shares are up around 2% here. Fixed income trading was a particular source of strength for them, but I know we're still going through those, and their call is later because they report a little bit later in the morning than the other guys.
Yeah, they really got to move that up, Julie.
Yeah, I don't know. You don't have enough ears for all of those.
I can always grow them, Julie. There's always a way.
I believe in you.
Yeah,
Thanks a lot, Brian. Appreciate it. Coming up, we'll count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Trade Desk, MP Materials, and CoreWeave. First up, shares of digital advertising company Trade Desk surging in pre-market trading on the news that it's getting ready to join the S&P 500. Trade Desk will replace Ansys before the start of trading on Friday. Remember, Ansys set to be acquired by Synopsys in a $35 billion deal. Also noting shares of Robinhood and AppLovin slightly lower today, both snubbed from that benchmark index inclusion once again. Next, rare earths miner MP Materials expected to get a $500 million investment from Apple. That's according to Fox Business and other reports. As part of the deal, the tech giant will buy U.S.-made rare earth magnets from MP's Texas facility. Shares of the miner are jumping on this news. And remember, it comes just days after MP Materials agreed to a multi-billion-dollar deal with the U.S. government to boost its output in an effort to compete with China. And as part of that deal, the government's taking a stake in the company. Finally, CoreWeave, building a $6 billion artificial intelligence data center in Pennsylvania. It's part of President Trump's push to boost AI infrastructure investment in the U.S. The announcement will be made at a CEO roundtable with Trump this afternoon, where the administration is expected to announce about $70 billion in AI and energy investments. That's according to Reuters. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, investor sentiment surging to its most bullish since February. That's according to Bank of America's latest Global Fund Manager Survey. Joining me now, Jeff Krumpelman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities. Jeff, it's good to see you. Where is all of this positive sentiment coming from, right? Given that there are things that in normal circumstances might give investors pause, including uncertainty on the tariffs and sort of the economic environment more broadly. What do you think's going on?
So, well, it began certainly after the tariff, timeout, which made a lot of sense because it looked like the tariff rates were going to be just, very difficult, very high rates, could really slow things down from an economic standpoint, maybe lead to inflation. And after the timeout, a lot of that kind of pressure has been relieved. And success breeds, confidence. So the market rallied on that, feeling like, hey, the economy continue to grow. It won't be as inflationary, and maybe we'll figure this out. And so the market has just surged since then, and that's made people feel far more comfortable about where things are. We've maintained confidence, quite frankly. So many of our peers, they reduced price targets, they dramatically increased odds of recession, and we just thought that was premature. The data looked pretty good throughout. So this was a confidence psychology PE cycle. The data and earnings pretty much, remained intact. Multiples just went all over the map because of this confidence that you're talking about.
What's the difference between confidence and complacency, Jeff?
Well, you don't want to be complacent. I think confidence says we're looking at the trend in the data right now, and it's resilient, and there is good logic for this market to be trading at 6,100 and to move higher. However, you've got to continue to follow the trend, and it could shift. All of a sudden, we have the president threatening all kinds of tariff rates that would go back to higher levels. We've got kind of nits with Federal Reserve Chair Powell. We don't need to mess around with that stuff. You really do need to see tariff rates moderate, come in at decent levels. You need to follow the CPI data. And today we got pretty good news. It says so far, so good. It's pretty contained. And you need to follow the earnings and rates. And as long as that trend doesn't change dramatically, you can be confident. But you better not be complacent and say, who cares about the real data? I'm just feeling good. The market's up. You can't do that. So we're very data intensive.
Yeah, I want to dig into a couple specific stories here too, because we can't ignore what's going on with Nvidia this morning, Jeff, and the rise that we're seeing on the signals that Nvidia said it's getting from the US government on its ability to export certain chips into China once again. Do you think that this is a signal, not just for Nvidia investors or say AMD investors, but to the market as a whole, that maybe things are thawing between the US and China?
I don't know. It's really hard to read. I mean, this is, you're drinking news through a fire hose this year on, the tenor. There have been, on the counter side of that, there have been tariff threats now, secondary, countries like China that deals with Russia, 100% tariffs are thrown out there. We still don't have a trade agreement. So that's where your comment about don't be complacent, I don't know. In terms of Nvidia, definitely a stock that we own, definitely a leader and beast within AI, and that's not going to go away quickly. I wouldn't be overweight the stock, but I'd want to own it as I would the general technology complex. But whether or not this is some major thaw or inflection point, I think it's way premature to make any kind of, bold pronouncements, like that. I would be cautious and careful and measured in evaluating what's going on. Day-to-day news flow is just wild.
And then speaking of day-to-day news flow, the bank earnings that we got here this morning, what's your investment in the financials and what's your view of what we heard from them?
This year, I think it's been important. We said you got to remove portfolio imbalances. One of those would be overweights to Mag 7 and overweights to growth in general. So financials fit in that cyclical area. We have increased our cyclical exposure this year, trimmed a little bit from those growth areas. We've increased financials weighting and industrials and selective in consumer discretionary, and it's paid off handsomely as we've done that. I think the JP Morgan news was good. That positive sign that gives you confidence. It looks like their trading activity and capital markets activity, M&A activity, and the corporate advisory picked up that says maybe CEOs are a little more confident that things are thawing and that they can make plans. So, 9% growth, nice revenue growth, JP Morgan, great management team. I think that's pretty good news. And we would want to modestly increase exposure or certainly maintain what we've got to financials right now. It's been a leading sector this year.
Jeff, great to see you. Thanks so much for being here.
Thanks. Appreciate it.
Coming up on Yahoo Finance, we've got Opening Bid. Our own executive editor, Brian Sozzi, he's back with us. Wow, I didn't know if I was going to see you because you've got different calls in every year there.
I have earnings call. They're just running live in my head, Julie, but I'm going to put that off to the side. I'm going to focus in on getting you some early information here. We're really digging into all things bank earnings, as you have done on Morning Brief this morning. I'm very interested in what Jamie Dimon called out in prepared remarks on earnings release, noting that asset prices are elevated. Now, does that mean a market top? Is he concerned about valuations? We'll dig in there. Of course, more to be said on that Nvidia news. You would have to think that earnings estimates for Nvidia should rise pretty significantly over the next 12 months in light of this development.
Very excited to hear more about all of that. That does it for Morning Brief. In the meantime, we got much more ahead on Yahoo Finance, including Opening Bid.